Sorry about that. I was on mute. Good morning, everyone. I would like to welcome you to the 2021 Agribusiness Management Program Virtual Summer Seminar. My name is Jessie Schupman. I'm going to be the moderator for the session today. I'd like to go ahead and introduce David Wessel, Illinois Soybean Association At-Large Director, to give us a quick welcome.
Thank you, Jessie. Good morning and welcome to day one of the 2021 AMP Virtual Summer Seminar. We are excited that you could join us once again for our two-day event this summer. My name is David Wessel. I am an at-large director for the Illinois Soybean Association from Chandlerville, Illinois. I also serve as chairman of the ISA Utilization Committee, and my wife, Tama, and I have two children. We raise corn, soybeans, wheat, and some cattle here in West Central Illinois on our 100% no-till farm. It's my pleasure to share a few words on behalf of the Illinois Soybean Association with you today. We are thrilled to once again host our AMP Summer Seminar, a free two-week lineup of exciting topics. We have brought in experts on a host of agribusiness topics, including estate planning, tax legislation, managing landowner-tenant relationships, and more. Our hope is that the soybean farmers and agribusiness professionals can use AMP as a go-to resource for advice and guidance. Through AMP, we hope that farmers and farm families find peace of mind for their decision-making, endurance in running their operations, and legacy in the ability to see their farming operations through to the next generation. We believe that farmers are leaders both for their family farming operation and the agricultural industry. And the AMP webinars deliver information that's needed for today, for this season, and for farming operations for years to come. And that is check off money well spent. Thank you for tuning in this morning to this morning's session. And I hope you join us for next week's lineup as well. For more information on AMP program offerings, be sure to check us out at illsoyadvisor.com. And I thank you and have a good day.
Thank you so much, David. So let's go ahead and get started with today. This year's AMP seminar is brought to you by the Illinois Soybean Association Checkoff Program in partnership with Illinois Farm Business Farm Management and the University of Illinois Farm Doc team. We'd like to take a moment to recognize and thank our AMP sponsors and program sponsors, AMP partners and program sponsors, excuse me. That would be the Illinois Farm Bureau and the Farm Financial Standards Council for making this event possible. Before I introduce today's speaker, I have just a couple of housekeeping items to mention. All of the sessions during the seminar will be recorded and can be accessed on illsoyadvisor.com. If you have any questions during the presentation, please type them into the Q&A function at the bottom of your Zoom window, and the speaker will answer those at the end. I'd also like to mention that there will be one CEU in professional development available for certified crop advisors attending each session this morning. At the end of each session, there will be a QR code for you to scan if you do not enter your CCA number during registration. We appreciate the opportunity to partner with CCAs and to offer this additional benefit. This morning's session is brought to you by Country Financial, and I'm happy to introduce Scott Jensen, Financial Planning Consultant with Country Financial, presenting the Farm Legacy and Planning for Tomorrow. Scott's located in Salem, Oregon, and provides expertise in all areas of financial planning, including business consultation, business continuation, investment management, education, insurance needs, and retirement accumulation and distribution. As our families grow in size and wealth, we must take steps to efficiently transition assets to the next generation. This workshop will focus on reviewing your estate and transition planning objectives while providing real-life examples and solutions. Scott will discuss opportunities and options that may work for your operation and start the conversations of these challenging topics. Take it away, Scott.
All right. Thank you very much, Jessie, for those kind words. Yes, I am Scott Jensen. I am the Manager of Financial Planning Support at Country Financial. We're excited this morning to be able to participate in this great program that helps support our farm community and help everyone to be successful in that key component of our society. And so as we go through, as mentioned, please feel free to submit questions in the Q&A using that functionality at the bottom of your screen. And we'll try and address them as we approach the end of our discussion here this morning. We'll attempt to share my screen here momentarily and make sure that that works properly for everyone. All right, so I'm assuming that you can see the screen, and so we'll go ahead and begin our presentation here today. All right, so as we kind of talk about farm legacy, of course, that means different things to different people. And as we go through the discussion, I want you to think about your own circumstances, your own situation, because at the end of the day, that's what really matters. It's not an aspect that should be generalized too broadly. So as we talk about some of these concepts, some of them may apply to you, some of them may not be directly applicable, but there hopefully will be some points of information that you can glean from it that will allow you to better understand your own circumstances and how you might be able to proceed. Now, we can always get caught up, be busy working, doing the day-to-day activities, and so sometimes we don't always allocate appropriate time for planning, but planning is important. It makes us slow down and focus on the things that we really want to be able to accomplish in the long term. Helps us identify those things that are important to us and prioritize our objectives. And so planning is something that, as the manager of financial planning support, I really can't go without saying how important it is. And we encourage everyone to allocate time occasionally for that planning process. As you're working with a professional who can help you through that planning stage, you should be working with individuals who help you choose strategies and solutions that accomplish your goals. They shouldn't be there to tell you necessarily what to do, but they should be able to provide you information that will allow you to be able to make an informed decision on your own. And if they're doing a good job at that, you're going to have the information that's going to allow you to make those best decisions under the circumstances that are facing you at that point in time. And that's an important thing to understand, is that really nothing ever stays the same. Not the economy, not taxes, not the financial markets, not you. And so that change requires that you're periodically stopping and reviewing your situation. Make sure that the plan that you may have discussed in the past still reflects things that are currently important to you and your family. So it's a dynamic world. Your plans, whatever those should be dynamic in nature as well. All right, so let's kind of, when we talk about planning, and one of the very first things that's involved when we're talking about legacy planning, as we're going to focus on today, or other types of planning, you really have to start with identifying what that objective is. Okay, what are you aiming for? If you don't understand what you're aiming for, going to be hard to be able to gauge whether or not you've been successful in accomplishing it. So defining the objective is important. And with respect to farm legacy, it may be very common for individuals to ask themselves, do I want the farm to be continued by my kids? Okay, it's been in the family for generations. Is that something that I'm passionate about continuing? Do we want them to have that opportunity? Or maybe, is it something that that can be transitioned, sold at retirement, and that it can be a resource there to help supplement the other assets that one might have to carry out their retirement goals. And so defining those things may be important. For many individuals, as they're contemplating either of those first two questions, they're going to be very concerned about the tax impacts. And so they're going to want to identify ways they could potentially minimize that tax, whether it be upon the sale of the farm or whether it be passing it on to the next generation. What kind of liability potentially? I know future discussions here, I believe, are going to talk about estate tax liability and some of those concerns. So who among us doesn't want to try and limit the amount of tax that we owe? And so that's an important consideration to think about. And then a frequent one that many individuals have to come to grips with is, do they want to be, or what is that picture of equitable treatment between those heirs of theirs who might actively be involved in farming versus those who really aren't participating in the day-to-day activities. In today's world, we're continuing to see a shrinking of that farm population, if you will, as children go off to college and they go down a different career path than that of agribusiness. And so they end up somewhere different than the family farm. All right, so after having identified those objectives, you remember and keep in mind, these are different objectives that you may have than what your neighbor may have. So everyone's situation is unique, and what's good planning for you may not necessarily be good planning for somebody else. So the planning, if it doesn't fit your family and your specific situation, then that's a problem, of course. But remember that first step, we start with identifying the goal of things that are important with us. And then we can, once we've identified where we want to go and what that looks like, it's appropriate then to start formulating some different strategies, some different approaches, some different paths that will help you get from point A to point B. All right, so we're going to kind of illustrate some of these concepts that we might talk about in farm legacy planning today by looking at two hypothetical examples. So we've got our first farm family, Jerry and Joan Walters, who are we'll kind of explore here momentarily. And then later we're going to transition into a discussion about the needs, primarily long-term, how do they pass the farm on to their boys, of Mary and Clifford Jones here. So let's start with Jerry and Joan here. So Jerry and Joan Walters, typical farmer family here, so mid-40s, been at it for a few years here. They've got a couple of children, one of whom is still a minor. They have 500 acres or so that they farm, that they own. Give or take, we'll say that those are valued at $4,000 an acre. And they have another 500 acres that they also farm, but they don't own. So they're renting that land from a neighboring farmer. And as is very common with many of our farm families, they're carrying some debt, a substantial amount here, $500,000 of land debt that is still playing a role in their overall picture. And they have not presently done any estate planning to this point. So they have no wills, no other legal documents that help guide those processes should one of them pass away prematurely. So that's Jerry and Joan Walters here. And as we kind of think about the things that might be of concern to them, they, as would be common with many individuals, are probably wondering whether or not they need a will. Okay, they probably have come to that conclusion that it's something they should be thinking about. And if nothing else, they have that minor child, John, who's 15 years old, really not capable of being on his own. And so they have some concerns there about how they might take care of John. That $500,000 of debt that's hanging out there is an ongoing concern for them. And they need to make sure they can have plans in place to repay that should something happen. And if something were to happen, undoubtedly there would be concerns about if Joan were the survivor, how she might be able to continue things. Yes, she could potentially rent out the farm acreage that they presently own themselves, but she's not going to necessarily be able to drive an income from the other 500 acres that they don't own. And so one way or the other, she's likely to experience a decrease in income from that situation there. So there's some concerns that exist here for the Walters, and we'll talk about maybe some ways in which they can address those different concerns here this morning. All right, before we kind of get into maybe some of the discussion here about some of the planning that they should do, I'm going to set the stage a little bit and talk about the law of intestacy. So intestacy is that circumstance, that setting, that situation that exists when someone passes away and they do not have a will in place. Okay, so there are no legal documents that they've executed that help tell society what they plan on doing. And so no worries, the state in which you reside has already drawn up a will for you. And so that is known as intestacy. And so each state has a series of different regulations that determine who's going to get your money, who's going to get your assets if you happen to find yourself in a situation where you've passed away without a will. And so it does vary a little bit from state to state, though there is a high degree of commonality with lots of those regulations, but it's still, nonetheless, it can vary state by state. Some of the common examples that we might see with those intestacy regulations might be a situation where that if that surviving individual or that deceased individual has a surviving spouse, that maybe one half of their assets might go to that individual, and the other half of their assets are going to pass to their children, regardless of the age that they might be. Well, that obviously can be problematic, both in terms of being able to provide for that surviving spouse if they're losing half of those assets to their children, and leaving money to kids or leaving assets to kids, particularly those who are inexperienced, is a red flag in many cases. So I have 5 children myself, ranging between the ages of 16 and 26. There are very few of them, and they're all great kids, but there are very few of who I would prefer to leave large sums of assets to and trust that they would be capable of appropriately managing them on their own. So that's a common thing that we might see often. There's also many states that follow regulations that basically say that if a couple had children and those children were only attributable to that marital relationship there, then the spouse is going to get all the money. But if there were any children that may have came from a prior relationship, then that money is going to get divided, kind of like we talked about before, half of it going to the surviving spouse, half of it to the children. And so the bottom line is that intestacy laws can be complex, and we want to encourage individuals to recognize that that's not the ideal way in most cases to deal with your estate, by essentially relying on those preset rules that the state has established that may not really mesh up well with your vision of how you would want things to happen. And so it's going to be always best to consult with a local lawyer, an attorney who can specialize in estate law and help you make those decisions to craft those documents to make sure that your assets go to the individuals that are important to you. Now, one of the things that we also want to touch on here while we're having that discussion of passing assets is the role that probate might play. So most of us have probably heard of probate, may not fully know what that means unless you've experienced it with your family member. So probate is really the legal process that is used to help administer the affairs of an estate and ensure that all the boxes are checked, that everything has been done properly in accordance with the law, that debtors are addressed, that or creditors, I should say, are addressed, that individuals listed in one's will, or in the case of intestacy, that the rules associated with it are followed, that everything is squared away appropriately. And so in that understanding, there are different types of assets that are subject to probate and may not be subject to probate. So assets that might be found in one's individual name. So if I have a piece of property that is registered solely in my name, that's an asset that is going to be subject to that probate process, either via intestacy or through the administration of my will. If I have assets that are registered as tenants in common, so I own it as tenant in common with someone else, my portion of the ownership interest in whatever that asset may be is also going to be subject to probate. Additionally, if I have assets that do allow for some type of a beneficiary designation, maybe it's a life insurance policy, maybe it's a beneficiary designation on an IRA or 401k or something along those lines, and that beneficiary designation specifies that the beneficiary is my estate, well, that is also going to throw it back into that category of being subject to probate. And so that sometimes there's good reasons to do that. Other times that may have been an oversight that we would be concerned about. There are assets, by the way, that by their very nature pass outside those typical probate regulations. via what we call the passing or under the construct of law. And so that's going to be things like assets that are titled as joint tenants with rights of survivorship. Those types of things will not be subject to probate because that joint tenancy creates a clear definition of who is that owner of that asset subject to or after one's passing. Life insurance is going to be a common thing that unless you've designated the beneficiary as your estate, that beneficiary will receive those assets, once again, outside of that formal probate process. And that can often be a helpful thing for many estates, many individuals and surviving family members, so they don't have to wait for the delays, issues, challenges associated with probate there. Retirement plan accounts, so IRAs, 401ks, 403bs, those types of employer-sponsored or individual accounts with an appropriate beneficiary designation will also bypass probate, and that can be a very important thing to consider. And for bank accounts or investment accounts that aren't inside of a tax wrapper, such as an IRA, you may have the opportunity to establish a POD, which stands for payable on death, TOD, which stands for transfer on death, as means to essentially have a contract, a designation there as to who is going to get those resources upon one's passing. Probate's worth avoiding in many cases if you can. It certainly costs money to the estate to be able to administer it, whether that be court filing fees or otherwise. It takes an extended period of time that is going to drag out that process and may create some issues there for the surviving spouse or family in being able to proceed with their life after that. And one of the big reasons that probate is worth avoiding, if possible, for many individuals at least, is that probate is a public experience. So any of those assets that are going through that probate process are made, the information about them is made publicly available. And so oftentimes individuals don't want to air that information with the public. And so that's a good reason to try and bypass probate where possible. So if we kind of return back to the Walters and their situation here for a moment, remember, they had a minor child. They have John here, who's 15 years old, maybe not entirely accurate with our picture that we have on the screen here. But nonetheless, it would be entirely reasonable for the Walters, for Jerry and Joan, to be concerned about leaving John there and what's going to happen to him. So in the absence of a will, the courts are going to want to identify who an appropriate guardian for John may be. And so they're going to look at a number of different information. They're going to require that an individual petition the court and provide them with background information, with public record history, their relationship to the child, other types of things along those lines. And it's not necessarily guaranteed that that surviving spouse would be the designated guardian for that child. In most cases, they probably would be. But nonetheless, it's an unwanted hassle and really is at an inconvenient and probably, well, certainly an emotionally challenging time for those surviving family members. And so we can avoid having to have those guardianship decisions established by a court when we have minor children. That in and of itself is a valuable reason to have an executed proper will that helps identify a guardianship for any minor children that may exist there. So as we kind of look at a will, there are some distinct advantages that can help many individuals here. And so will helps address that their property can be distributed without having to be subject to those intestacy laws for the state in which they may live. It's going to allow them to identify a guardian for their son, John, which is very, very important as long as he's a minor there. For that individual who's representing the estate and carrying out the affairs of that will, it's going to allow them to avoid having to have a probate bond. So it's going to save some money on that side. It's going to allow them to be able to choose who that executor is without relying on the court to identify someone to carry out the requirements. So they get to be in control there. It's going to allow, importantly, for distributions to minors to be deferred. Absent that, it's going to follow the regulations, and that may distribute those resources to minor children who are incapable of appropriately managing them, placing them in kind of a guardianship or custodial situation that can be problematic and difficult to deal with. And so by allowing a will to defer those distributions beyond potentially the age of majority, which for most states, that age of majority is going to be 18 to 21. And as I mentioned before, while you may have great kids, there's not a lot of them that at that point in time are going to be capable of appropriately managing significant sums of resources. And so a will is also going to allow them, should they so choose, to make specific bequests to family members or charities, anything along those lines. Is going to allow them to have their final say in what they want to have happen with their assets, rather than just following the pre-described regulations and who's going to get the money under those circumstances there. All right. So remember, we kind of talked about the suite of different concerns that Jerry and Joan had as they were talking about their situation. They wondered if they need wills. I think we can all come to the conclusion that yes, they really should have wills for guardianship purposes. They should have it to control the destination of their assets upon their passing, rather than relying on those intestacy rules there. So yes, they should have a will, and there's good reasons to do so. Remember, they still had some other concerns, though. What would they do potentially with that $500,000 of debt that is still outstanding there? And how is Joan going to be able to make it financially, month to month, year to year? Yes, she may be able to rent out the 500 acres that they own, but the 500 acres that they were farming, that income's gone. So there's going to be some obvious concerns that still are going to be there that a will won't necessarily address for them. So it probably doesn't take a rocket scientist to identify that if you've got concerns about at death, that there might be debts that you might leave behind and or a need for supplemental survivor income, that one of the effective instruments to be able to address those concerns is the use of having an enforced proper amount of life insurance. And so that would be definitely something that the Walters should be considering as they're engaging in that broader estate planning discussion there. And one of the things that we really haven't talked about are some other contingency plannings that the Walters should be exploring here as they do that estate planning. They need to be thinking about having a durable power of attorney. So should they become incapacitated, whether that be physically or mentally, something to help manage their financial assets, their property, help them make healthcare decisions, so living will, advanced care directives, those types of things that will allow for those contingencies that if they don't actually die, that whatever event occurs just makes them incapable of administering their own affairs, that they've planned for those accordingly as well. So now, as we've kind of talked about the Walters, let's kind of segue here into a different set of circumstances or concerns that may be commonplace. And we're going to use Mary and Clifford Jones as our sample family here to talk about today. So both of them are mid-60s and kind of wrapping up, if you will, some of their farming involvement. They've got their two children, Bill and Bob. Bill is actively involved in the farm, helping out day to day and running things there. They, as mentioned before, have 500 acres valued at about $4,000 an acre, so give or take $2 million of value to that land there. And they've got some important objectives that at least are important to them, okay, as a couple. They want to make sure that the farm has that opportunity to continue in the family so that Bill can continue farming it. And yet they love both their boys, and they want to make sure that they're being fair and equal to them after they've gone. So as we kind of talk then about the parents' concerns, well, they may have, the question, should Bill, their son who's involved in farming, should he have that opportunity to continue farming, okay, if he wants to. They may want to explore how they can treat both children equally. And beyond that, is there a difference between fair and equal? And, if they aren't necessarily equal in how they're distributing things, is that still going to be fair? If Bill wants to buy out his brother, if they say, hey, we're going to make it equal, we'll just give it 50-50 to both boys, is Bill going to have the ability to be able to buy out his brother Bob? So should it be able to continue the farm that being as one entity, or should it be split up? And as they continue to divide that land, of course, that becomes harder and harder for the survivors to be able to address it. Now, beyond the concerns that mom and dad may have, the boys may each have their concerns. So Bill, the farming son, he may be concerned that if he kind of jointly inherits that land, does he want to essentially rent out half of it from his brother Bob? Okay, that can enter some awkwardness into the relationship at times. And if that's the case, if they're jointly owning it, maybe, would both Bob and maybe Bob's wife agree to some of the farming needs that Bill may have? Maybe there's some improvements that need to be done. Would they agree to that, since it's going to hit their pocketbook as well? If there's a bad year, and you all know that that is going to happen on occasion, and it's the nature of farming, what's going to happen? Will Bob and his wife or their creditors, will they wait patiently until things get righted there? If he's going to buy it, can they establish a fair market value that's appropriate without having to go through the process of a public sale? And even if he is able to do it, where on earth is he going to get the money? Okay, so if he's going to have to buy half that farm land, which may be worth approximately $1 million in value there, where is he going to come up with the funds, the resources to be able to do so? So he may be able to borrow it. Maybe he might have his own concerns about credit worthiness or the ability to qualify for a loan there. And even if he does qualify for the loan, can he afford to make the payments associated with it and still generate enough money from the activities of farming there to make a good living? Now, his brother Bob likely has his own concerns, and they're probably 180 degrees out of phase with some of Bill's. He may still be concerned that if he is a landlord with Bill, are they going to get along? Okay, or will that sour the relationship? Is he going to get a fair return on his inheritance? Maybe he's got other ideas of what he might be able to do with those proceeds that, in his mind at least, might be more productive there. And if he were to sell it, who's going to buy it? Would he have to go the route of that public sale, which, of course, may be adding insult to injury if it gets sold to a competing or a neighboring farmer rather than his brother Bill? And if he does, what kind of those repercussions may be there to the relationship that they have as siblings? So as we kind of talk about maybe some methods that the parents, Mary and Cliff, may have at wanting to maintain and achieve their particular goals here, well, they could choose to gift the farmland outright via bequests or otherwise to their boys. They could include in their legal documents, their estate planning documents, an option for Bill to purchase it, kind of a first right of refusal, essentially. They could enter into an installment sale with Bill, kind of sell it now and begin that process. Or they could establish a buy-sell agreement between them and Bill as a means that would outline what would happen at some future point there. For the sake of today's discussion, we're going to kind of focus on that second option, that option to purchase, which for all intents and purposes, we're going to say that Clifford has passed away, and so Mary is the surviving spouse in that relationship there. She has the full assets of the estate in her name. There's the $2 million of farm resources and another $250,000 of investment assets. And so the $250,000 of cash, that's pretty easy to divide up. Each boy is going to get $125,000 upon Mary's passing. The farmland could state that in their will that it would be sold to Bill. And Bill's going to inherit basically $1 million of it, half of it without any problem there. But he's going to have to generate the other $1 million in order to be able to satisfy the needs and provide for an equal inheritance, if you will, to his brother Bob. Now, as we kind of look at that option to purchase that Cliff and Mary may have built into their will or other estate planning documents, it can be very functionally beneficial and helpful because it can help establish for them the price that might be associated with that transaction. If it's going to be financed between the parties, it may be able to establish interest rates either as a fixed amount or a function of prevailing interest rates at that point in time, as well as establishing a payment period, the timing associated with when payments are made, how many times per year, et cetera. So it kind of helps provide some clarity to all the parties that are involved. So there's a clear understanding of how each party is going to react, and it's a fair and equitable manner. Help promote a successful farm transition and maintain a circumstance that could result in better family dynamics, because everyone kind of knows what to expect there. Remember, it's also non-binding. So if the circumstances have changed between the time that Cliff and Mary executed this as part of their will, if it's no longer appropriate or desirable for Bill to exercise that, he does not have to. It's an option. And so in which cases, then it could just be divided if he doesn't exercise it between the two boys. It was kind of previously identified there. So let's say that Mary and Clifford and all the different options that they were exploring, they decided that they would want to use that option to purchase as the method to address the farm, okay, and some of the goals they have. Because what it's going to do is it's going to ensure that Bill is given the opportunity to be able to obtain the farm and be able to continue that in the family if Bill wants to exercise that opportunity, right? Something may have come up between the time and that may change, but if he wants to, he's got the option to do so. They've laid out that landscape. Everyone knows what their role is, how much they're going to pay, if it's going to be financed through a seller carried note, kind of what those terms are. So that farm continuation objective has been met, and it's provided for some equal treatment. So Bob isn't just sitting on the sidelines where his brother Bill got the farm and he didn't get anything. We've provided a means for fair and equal treatment. And so as Mary and Clifford look at it, they are content, they're happy that they've been able to address that process there. Now, as we kind of look forward, just because maybe they've identified that that's the direction they want to go, that doesn't necessarily mean that it's always going to happen real smoothly. And so remember, Bill now is maybe aware of this option to purchase. And so now he has to contemplate and struggle with how is he going to address paying for said purchase. Okay, well, if possible, maybe he's got the money in cash. He needs $1 million. My guess is that's probably not the circumstance. Very few of those individuals in similar circumstances are just going to have a spare $1 million lying around that they can fork over to facilitate that purchase. So probably not. He could potentially say, hey, I know that mom and dad, they're mid-60s now. Maybe they've got another 20 years of life ahead of them. I'm going to start saving with the intent of building up those reserves so that when they pass away, I can have the money to pay cash for that. That's great. Okay, fantastic. Assuming that Cliff and Mary actually live the 20 years and allow him to have that time to save. If they pass away quite prematurely, then that he may have a very insufficient amount of time to actually save his way to success in that aspect. He could, of course, potentially borrow the money. And the option, as we kind of talked about within the will, may prescribe the circumstances in which he could borrow the money essentially from his brother through a seller finance note, or he could go down to the local banking institution and try and borrow the money there. And he could also consider potentially having life insurance on mom and dad that could help provide the resources, the cash necessary to be able to carry out that purchase option at the time of his parents' passing. So we're going to kind of focus on the last two and kind of as how those might play out as a means to address his options, because he probably doesn't have the money right now, and we're going to assume that he may be concerned about having the money long-term, being able to save his way to a successful solution. So he's going to focus on either borrowing it or using life insurance. So let's kind of look here at maybe comparing and contrasting some of those. So as we kind of identified before, there's 500 acres, each valued at $400 per acre. And so the total farmland value here is somewhere in the nature of about $2 million. And so Bill's share of that is about $1 million. So that means he only really has to still buy out that $1 million that we talked about there. So if he's going to go down and secure a loan for $1 million, and he's going to finance that over a 20-year period, and let's say that he's got a 5% interest rate hypothetically on that loan, well, that means that he's going to have annual loan payments of about $80,000 per year. So about $6,700 per month, every month, 240 months in a row. A lot of money, okay? Total outlay over that 20-year period, about $1.6 million. So he's paying, because he doesn't have the money up front, he's essentially paying a premium, if you will, to buy something that's worth $1 million. He's paying 1.6 for it. via this loan that he has to secure in order to make it all happen. And so that totally can work and maybe the route that he ultimately has to end up going when it's all said and done. There's some advantages and there's some possible disadvantages to that. Well, some of the advantages potentially, of course, is that loan, in most cases, the interest associated with it is going to be tax deductible. And so that can be less painful, ease that burden somewhat. And it does allow him to spread those payments over an extended period of time, making each of those payments a little bit more palatable. And because of the nature of those payments, generally speaking, assuming it's a fixed rate loan, that those payment amounts are fixed over the course of that 20-year period. As time goes on, those payments towards the end are going to be able to be paid off with interest, or excuse me, with payments that are generated that are inflation impacted. So as his income from operations tends to increase because of inflation, it'll make it somewhat easier over time to make those payments as time goes on. Now, there are some disadvantages though, and so he still has to have terms that he can stomach, that he can agree with his lender. That he not only has to pay back the full $1 million that he borrowed, but there's going to be interest, as we talked about. That's $600,000 of interest in this situation. And of course, that's going to have an impact on the cash flow of his operations. He still has an $80,000 per year hurdle that he must overcome before he's even able to start generating any income for himself and his family. And so that loan payment becomes a big stumbling block in some cases there. There may be some additional down payment that he's required to put down in order to meet the terms of the loan with the lender. And of course, as mentioned, farming is a difficult, volatile occupation. And so while it may look on paper that he may be able to cover that $80,000 payment and still provide appropriately for his family, if circumstances change and he goes through some difficult farming years, that profitability fluctuation may throw that all out the window. And so some of those disadvantages to borrowing make it a concern there. So he's kind of done his research, understood maybe the pros and cons of potentially borrowing the money to facilitate the purchase under the option within his parents' legal documents there. And so now he's going to maybe evaluate, well, what if we look at life insurance? And so life insurance as a means has some potential advantages. And so we're going to assume one of the types of life insurance policies that does exist out there is what we call a survivorship or second to die life insurance policy. And that would be a policy that would insure both Cliff and Mary, his mom and dad, and would pay out at the exact time that the money's actually needed for this transition. So that would pay out upon the second passing, whoever that may be, that second individual passes away. Those proceeds are generated on an income tax-free basis. So it creates that money at the exact right amount of time. Those proceeds are income tax-free. In some cases, some of those policies may be ones that contain dividends, and as those dividends are reinvested, they can help provide a little bit of an inflation guard. Not every type of policy has dividends, and for that matter, dividends are never guaranteed, so not something that you would necessarily want to bank on there, but does help provide the resources to then carry out the purchase, whether that be as that option or maybe a buy-sell that might have existed there. It helps minimize the disputes among the children because we've got the cash on hand that allow for that process to continue without impediment there. There are disadvantages to life insurance as well. You got to pay the premiums, and those premiums on $1 million life insurance policy for a couple age 65 are not going to be insignificant. And of course, with respect to life insurance, not everyone can just get it. So you do have to go through an underwriting process, and that process may limit the abilities of some individuals to qualify. But nonetheless, if we kind of look at that same evaluation that we did before, and we say that total farmland's worth $2 million, Bill shares $1 million, he needs $1 million to buy out his brother. Well, if we were to look at a hypothetical example of a survivorship life insurance policy with a 20-year premium payment, we might be looking at premiums in the neighborhood of $25,000 per year. So that total outlay over those 20 years is $500,000. That's significantly different than what we saw before. In fact, when we kind of compare that, what might be needed to generate that $1 million to purchase that land, Yes, you can borrow it, and that may be the only route if Mary and Cliff aren't insurable, but it's going to cost you a premium. It's going to cost you essentially $80,000 a year for 20 years, $1.6 million total. In other words, that acreage that today is only worth $4,000 an acre, you're having to pay about $6,400 for per acre. Whereas with life insurance, being able to use the tax-free leveraging capabilities there, that may significantly reduce that total outlay, making the life insurance about 1/3, even a little less than 1/3 the cost of what it might cost to borrow the money to carry out that option at the end of life. So as we kind of mentioned, both may be options to consider. And if interest rates are really, really low, maybe borrowing looks attractive. And of course, those life insurance premiums could get much higher if Mary and Cliff are of questionable insurability there. So kind of summarizing, our discussion here this morning, remember that estate planning, legacy planning in the farm community is not a one-size-fits-all approach. That you should try and tailor the approaches to those things that are going to be best suited to your individual circumstances. It is your farm, it is your family, and the solutions that might be considered really should focus on your situation there. So having family-specific objectives about what's going to happen with the farm or what's going to happen with your heirs is very, very important. That you do need to consider the needs, the circumstances of those individuals who might be participating in the farm and those who may not, and how to appropriately, fairly address those concerns. Because at the end of the day, most families want to maintain harmony. They want to maintain peaceful, loving relationships going forward. And unfortunately, too often, some of these estate circumstances can drive a wedge between family members, which is a sad outcome that hopefully can be avoided with proper planning. And there are different solutions to consider, many different funding options, from having the cash available, from being able to save, borrow life insurance. Find the solution that is going to be appropriate and best suited for you. Set aside the time to plan. Don't necessarily be reactive, be proactive. Talk with a local attorney who's well-versed in estate planning, financial professionals, insurance agents, accountants. It's a team effort to help you be successful as you're looking at these. And we encourage you to work with those local professionals who you may know, who are in your community, who are well-versed and can assist you and be able to make informed decisions. So with that being said, let's see if we have any questions. We're a little bit earlier than what we maybe outlined in our time here. Do we have some questions that have come in through the chat?
Hi, Scott. Yes, I am working on just getting those questions lined up here. Thank you for that information. Just a few on our mind at this point. So the first one, can you explain the importance of, as you were just mentioning, discussing your estate plan and your goals with your heirs or your beneficiaries, your other family members? How have you seen that be more of a positive outcome than when you don't discuss that with those individuals?
Yeah, that's a great question. I mean, let's face it, no one really likes to contemplate their own demise, okay? And we all know that at some point that life is finite, that we're going to pass away. So it's definitely natural for us to not want to have those conversations. But I think it really does enhance the relationship. And it is important to have those discussions with heirs. Now, maybe not with your 15-year-old, okay? Maybe we're not necessarily wanting to explain to him or her all the nuances of those plans. Not to say that maybe it wouldn't be appropriate, but by all means, as you age and maybe approach retirement and beyond, it is important to have those discussions. What it helps do as you do so is it removes ambiguity. Well, Mom told me this, Dad told me that, in some conversation that we had one day. Well, no, everyone's on the same page. We're able to incorporate the concerns. Maybe Mary and Cliff, in our example, assume that Bill wants to continue farming. Maybe he really doesn't. Okay, he's just helping out because he feels it's his obligation as their son, and his brother Bob is lives in a out of the area, isn't really able to help or interested, and so he feels it's his obligation to help his parents, but he really doesn't want to continue farming. And yet Mary and Cliff are under the assumption that he's helping us, he's going to take over the farm when we're gone. And so having those conversations, not only between the parents and their heirs, is important to provide that uniformity and that continuity, that common vision, gets both generations on board. And if it is important, if there are certain aspects of that legacy planning that the parents feel passionately about, it gives them an opportunity to communicate it in a situation that's not under duress. When the first time that heirs hear about something is at the reading of the will, we've all seen the movies that have these drama-filled experiences where an attorney is reading the will to the heirs, and all the chaos that sometimes results. And while maybe that's legitimately overrepresented in the movies at times, it's not to say that those still can't be similar outcomes in real life. And so the ability to kind of avoid that process up at that point in time when tensions and emotions are already at their wits' end is important. So by all means, we would encourage individuals to have those conversations early and to have them periodically. So just because you determined at age 65, for example, what you thought that the landscape should look like, it does not mean that at age 85, it's still what your feelings are. So that's a lot of time. A lot of water can go under the bridge, and it's important to make sure that that those plans are updated regularly.
Yes, I agree with that. I see that all the time in my line of work as well. Having those continuous conversations is really important, and coming up with an estate plan is great, and then making sure that that estate plan still fits into your life and what you want even further years down the road. So revisiting that is a really great option. Had a couple of other questions come in from our group here. Is it usually better to hold the sale of land until after death in order to get the stepped up basis?
That's a very timely question and very common one that many individuals will explore or be concerned about. So particularly if you inherited or purchased that land many years ago at a much, much lower value, and there may be significant appreciation that has occurred. And should that land be sold or prior to death, then yes, the capital gain is going to be recognized. Under the current legislation, at death, that basis gets adjusted. So we call it a step up. So basically, that prior purchase price gets ignored, and the new fair market value at the time of death becomes that cost basis. And so should the family sell that at that point in time, essentially there would be no capital gain generated. While that is the current legislation, there are concerns out there and proposals that have yet to be acted upon, but are certainly being taken serious, that would change that landscape such that there would be a loss in that step up in cost basis for many circumstances. So there's going to be some, or at least the legislation assumes that there would be some exempted amount that would still qualify for it. But beyond whatever that threshold is they ultimately settle on, that extenuating or that a gain would be subject to capital gains taxation even for the heirs at the time of passing. So yes, historically, holding assets until the time of death has helped reduce that exposure to the capital gains tax. Moving forward, that may or may not be the case as legislation changes down the road. I don't know if that answers it fully, but that's good.
Yeah, well, we always kind of laugh, the tax legislation is permanent until it's not. So we will see what happens here in the next several months and how all of that plays out.
Yeah, what's permanent is the government's appetite and unsatiability for tax revenue. And one form or another, they're going to get it. But how they choose to generate it that's what changes.
Yeah. Well, thank you. We have a few more questions that have come in here. Can you talk about the ability to cash in a life insurance policy in order to pay down debt or use that cash during your lifetime? Which life insurance policies are able to do that, and what do you need to do to start that process, as well as paying that back, and is that important before you pass?
Yeah, great question there. So permanent life insurance policies. So kind of in the world of life insurance, we have two broad categories: term insurance policies, which are temporary in nature. They generally do not have any equity or cash value to them. And then you're going to have permanent policies, such as whole life or universal life policies, that frequently do have some equity or cash value to them. And so that equity, that cash value, can typically be accessed through either surrendering the policy. So if the coverage is no longer needed for any purposes, you could surrender the policy and access that cash value. Keep in mind that if you have potentially, if that cash value has grown to be a sum that's greater than what you paid into it over the years, that surrendering that policy would generate a tax consequence. So you would have to pay ordinary income taxes, so a little bit more painful than the tax consequences of a capital sale. So ordinary income tax consequences on any gain if you surrender a life insurance policy. You do not necessarily, though, have to surrender a policy in order to access the cash within it. So most policies are going to allow you the opportunity to either take a withdrawal as part of that without having to surrender that coverage, or to access it via a policy loan. Withdrawals do not have to be repaid. And for that matter, a loan does not technically have to be repaid by you writing a check to the insurance company. But loans do have to be accounted for, tracked, and repaid either at the time of death. So if you borrowed $100,000 out via a policy loan, your death benefit is going to be reduced by that $100,000 as well when you pass away. So it kind of gets paid back at that point in time. Or if you were to surrender the policy prior to passing away, that $100,000 that you borrowed will be paid out or paid off via a smaller proceeds from the surrender of that policy. Okay, so it does have to be repaid that way. In most cases, with most policies, whether you're taking a withdrawal up to certain limits or a policy loan, those are going to be tax-free in nature. So no income tax consequences on those distributions. So sometimes that's attractive. That tax-free circumstance continues as long as that policy stays in force. So maybe you paid in cumulatively premiums of $100,000 into a policy over the years, and it's got a cash value of $200,000, let's say. Well, you could pull out $150,000. There would be no tax consequences as long as you're doing it through a policy loan, as long as that policy stays in force. Okay, but if you were to surrender that policy prior to death, then there would be tax consequences that would result because you pulled more money out than what you had put into it. However, at death, essentially those tax consequences get eliminated there. So even though that $150,000 of loan that you withdrew would be paid out or repaid by having a lower death benefit at the time of passing, there would still be no tax consequences that would result. So just be aware of that. Talk to your local tax professional, talk to your insurance agent. They should be able to help guide you through the exploration of those different options.
And to follow up with some of those different options and thinking about, well, when should I start with this estate planning? You know, what would be a good age for people to look at their estate valuation and, you know, kind of walking through creating a will and those kind of things? What age do you recommend, or what period in time in your life do you recommend?
Well, certainly in our examples, we had two individuals in kind of different phases of life. We had the Walters, who were a younger family, if you will, mid-40s. Definitely a point that they should have wills in place. Okay, so they had children. I mean, by all means, as soon as you have children where guardianship concerns are part of that picture, you really need to be having a will, if for no other reason than to help outline who those guardians will be. Maybe you're not at a point where you've got assets, early in life that you're worried about passing on, but if you've got heirs who are worried about caring for, that should be addressed with a will. As you grow in terms of assets and the complexity of your estate, the nature of the will and or legal documents that you might be executing is probably going to change. So that young family who just has a couple of kids, not a lot of assets, they need a will. Okay, So they should be talking with their attorney about getting one executed. But it's probably a fairly simple will in their circumstances. As time goes on and assets grow, the complexity of their situation, their estate grows, the strategies that might be used to address that complexity are going to change as well. And so, as we talked about before, where it's important to periodically revisit those plans and make sure that everything is up to speed and reflecting your current desires, current situation, addressing changes that may have occurred since the last time you did so with tax legislation, et cetera. You're going to want to make sure that that's done. So as far as when you should start, early on, okay, you got a family, you got kids, you need to have a will. A single individual with no assets, candidly, everything could probably be handled appropriately with intestacy rules and appropriate beneficiary designations on the little amount of assets that they have. But as you get married, as you have kids, you need to have a will. As you get older, have greater assets, more complex situations, those documents need to be modified to reflect the best approaches for those circumstances.
Okay, thank you for that. We've just got a couple of other questions here. In one of your examples, you had mentioned about $1 million worth of income coming in. So the question says, where does the second half of the $1 million come from with your life insurance or from insurance?
Yeah. So remember the circumstances associated with the Cliff and Mary's estate there. They had basically a farm that was worth $2 million, 2 boys. So he only needed to come up with $1 million because the assumption was that he received the other $1 million as a bequest at the time of death. So when his mother Mary passed away, he got half of the farm, essentially $1 million worth of value at the time of death through the distribution of that half under the administration of the will. The other half is where he did have to come up with $1 million to purchase out the interest that his brother owned. Okay, so that's how we got to the $1 million figure.
Okay, perfect. And then the final question we have right now is, how do we think about the other IRS pieces of regulation or guidance that allow us to have some special use valuation with farmland? And how do you consider that when you're thinking about these life insurance or insurance decisions?
That's a great question. So really today's presentation was pretty high level. We didn't get into some of the more complex strategies that are out there. There are some very important ones that can help farm families to adjust the valuation for determining, and that special use valuation usually comes into play as we're looking at estate tax consequences, which really we didn't even talk about or address in today's concern or in today's presentation. Nonetheless, for many farm families, there may be an estate tax. For those of you who happen to be in the state of Illinois, there's that $4 million exemption amount. Federally, it's much, much higher, and I know there will be additional presentations later on that explore some of those details there. Nonetheless, if there is a tax liability, that tax liability is at least due in part to the valuation of those assets. And so special use is a way to receive some relief in how that land or that property is valued that can reduce the value of that for the calculation of those estate taxes. At the end of the day, even after special use or other methodologies have been applied to try and reduce the taxable value of an estate, if you still happen to be above whatever threshold it is that you're concerned about and a liability exists, a life insurance policy is a very efficient means to be able to generate the liquid cash to address that liability. And so many farm families, even after all the complex strategies that they might have deployed to try and bring their valuations down to reduce that liability, if there still is some tax liability, life insurance is frequently considered as an instrument to address it.
Okay, well, thank you so much for all of your insight and your wonderful advice today. I just wanted to take a moment and go ahead and remind everyone that QR code is available, but that's all the time we have for this morning's session. So we're going to stop taking questions at this time. And Just a final thank you to Country Financial as our sponsor, and Scott. Again, we appreciate all of your insight this morning. So
You bet. Happy to help.
Oh, thank you so much. As I mentioned, please go ahead and claim your one CEU in professional development for this session. So you can either scan the QR code on the screen or email our team with your CCA number to be submitted for credit. And we're going to take just a minute here to get reset before our next presenter. And if you can give me just a moment, we will get Kathy Reinhardt on here. And I'm just going to get the PowerPoint presentation set up for her. So just 1 minute. I'm going to share my screen here in just a second, but I just wanted to introduce Kathy Reinhardt. She's the Secretary and Treasurer with the Farm Financial Standards Council, and she's going to give us a little bit of information today about the council and how they help us with a lot of different details. And Kathy, I'll let you take it away and get this PowerPoint presentation started.
Thank you, Jesse. Welcome from the Farm Financial Standards Council. We are pleased to be partnering with Illinois Soy and other ag organizations through the AMP program to provide valuable resources to help producers and agri-professionals to improve their skills in order to provide long-term viability for ag operations. The FFSC works to provide education to facilitate the development and promotion of uniformity and integrity in both financial reporting and the analytical techniques used for effective and realistic measurement for the operations of ag producers. One way we do that is through our guidelines for ag producers available through our website at ffsc.org. The FFSC is an all-volunteer member, not-for-profit organization with 154 members in 34 states and 3 countries. We have members from producers to academics to accountants to all lenders. We have quite a range of ag professionals. Please look us up on the web at ffsc.org and enjoy the program today, and thank you for attending.
Thank you so much, Kathy. We appreciate that. We appreciate your support and look forward to the presentation here from Christine. So now I'd like to introduce our second speaker, Christine Tigran. And Christine is going to be presenting how it works, what to expect through December 2021. This workshop focuses on how proposed legislation funnels through each sector of government and compares current estate tax legislation to the proposed estate tax legislation. The key to successful estate tax planning is to stay calm, educate yourself on potential outcomes of strategic management decisions, and obtain the desired tax result. Presenting this workshop is Christine Tigran, an adjunct assistant professor in the Agricultural Education and Studies Department and the director of the Center for Ag Law and Taxation at the at Iowa State University. Christine's work focuses on studying and interpreting laws impacting the agricultural industry. And particularly, she focuses on agricultural taxation. Before coming to ISU, Christine worked for a legal publishing company as a practicing attorney. She received her JD from the University of Texas at Austin and her bachelor's in journalism from Iowa State. And she grew up on a farm in Western Iowa. Christine, please take it away.
Thank you, Jesse, and thank you, Scott, for your great presentation on estate planning and just the basics of what we need to think about. So I go into a little bit of a different world here where I am going to try to make sense of what's going on in Washington. A little bit challenging because I don't think what's happening there makes sense to anybody, regardless of what party or affiliation or anything else anyone's a part of. It's just things are a little bit up in the air. And so all of the things I'm going to talk about today are just to help people out there try to understand all the terminology that's thrown around in the headlines, to understand what the various proposals are that are on the table, and to just get a sense in terms of how those proposals would impact farm families generally if they were enacted as they're proposed. But again, very few proposals actually make it across the finish line in their original form. So I'm not going to try to look into a crystal ball and tell you what's going to happen, because I don't think anyone would be successful with that approach. Again, today, I just want to give you the background that you need to really stay informed and up to date as we sort of watch what's going on in Washington and how it might impact us. So just a little bit of background is sort of important as we look at potential legislation. And the first thing I want us to remember is that we've already had a fairly significant piece of legislation passed this year. It was passed in March. It was the American Rescue Plan, and it was $1.9 trillion of spending. And so it's kind of becoming in the wake of COVID and everything else a little bit normal to talk in $1 trillion language when we talk about legislation, but these are very high numbers, folks. And so, we're sort of moving into uncharted territory as we talk further about additional $1 trillion bills that are pending. So I just sort of want to get that out there now. So if any of you out there have children, for example, you likely received a deposit in your bank account on July 15 for an advance of the child tax credit, for example. That was a 1-year provision that went into effect because of the American Rescue Plan. So those are the types of provisions that were passed in March. All of those provisions were just sort of 1-year pieces of legislation. And what is on the table now are items that would become more permanent. And so to become more permanent, they would also require a lot more funding. So at the end of March, we got the first proposal from President Biden for part one of his two-part, what he's phrased, the Build Back Better agenda. And so that was the American Jobs Plan. And what we're hearing it called right now is what's being discussed in Washington as the infrastructure plan. And it would actually be roads, bridges, rural broadband, et cetera. And we're going to talk a little bit more about that. But as originally proposed, that was a $2.4 trillion proposal. Then at the end of April, the president unveiled what has also been called the Human Infrastructure Plan. It's called the American Families Plan. And this is the plan that would put more money into social programs, essentially. And that's the plan that would be paid for with fairly significant tax increases. So that's the one we're really going to spend the bulk of our time today talking about proposals, because that is the plan that would have the most impact tax-wise on farm families. The current state of affairs is changing by the minute. I've been keeping up to date this morning, but I think as we're just talking now, something's likely changed. So I'm not going to go into detail about the current state of affairs, because whatever I tell you will be different and change by the time we get off this call. But what I do want to do is kind of give you a little bit of terminology, a little bit of understanding about what is this process that's going on right now. So congressional leaders have apparently or supposedly reached some sort of bipartisan agreement on that infrastructure bill, the one that the president had called the American Jobs Plan. And that was the one for roads and bridges and broadband, et cetera. And so there were Republican senators, there were Democratic senators that came together to sort of craft a much scaled down version of the president's original proposal. And a couple of weeks ago, they announced that they had come to an agreement. Well, as most of you realize, there was nothing in there really to finalize how it would be paid for, how the funding would occur. And so in the meantime, we've been having a lot of back and forth. We have no bill language that's been released. And the Majority Leader, Senator Schumer, just has announced last night, he did what we call file for cloture, and we'll talk about what that means in just a minute. But he's actually said that there's going to be a vote on this kicking off the debate for the infrastructure bill beginning tomorrow. Now, there's pushback on that because folks are saying, wait a minute, we don't even have any language to this bill. But then what Senator Schumer is saying is, if we don't get the debate kicked off, it's not going to happen. And we want to get some action before the August recess. So there doesn't seem to be wide support for moving forward, but we're going to see what happens tomorrow. To actually get past this point, and I'll show you what that looks like in a minute here, there would have to be 60 votes in the Senate that would agree that, yes, we can indeed kick off this debate process. And so the ultimate goal that we've been told is to get debate and some meat on the bones of this infrastructure bill so that there could actually be a vote on the substance of it later. And then whatever's left over in terms of the big American Families Plan would be put into a $3.5 trillion budget resolution. And that would be passed through budget reconciliation. And we're going to talk a little bit about what all that procedure means, because again, you hear this language thrown around and we sort of just quit listening after a while because it gets kind of cumbersome to sort of fight through the weeds. But it's really not that complex of a process. It's just specialized language that they use over there in the House and the Senate. But bottom line is there's a lot going on right now. But it could all be shot down tomorrow and we could be kind of starting over. So we're going to kind of see what happens. But basically, when we hear about what budget reconciliation is, the whole reason to use budget reconciliation instead of the normal legislative process is so that there can be legislation passed with only 50 votes in the Senate. Otherwise, normal Senate procedure requires 60 votes to overcome a filibuster. So if there's a party or a senator or someone who doesn't want to take up a particular bill or doesn't want to bring it even to a floor vote, they can overcome that by using the filibuster. And the only way past the filibuster under current rules is to get 60 votes, unless you pass something through reconciliation. And this is using the Congressional Budget Acts process, which was started back in the early 70s. And basically it says, okay, if you have legislation that impacts spending, revenue, etc., you can pass it by creating a budget resolution. And then you only need to get the 50 senators to vote. And then in this case, the tiebreaker vote would be vice president. And so there's some special rules. This is where it does get a little complicated with something called the Byrd Rule. And the Byrd Rule just says that you can have pretty wide-reaching budget reconciliation bills, but you can't include in there things that are called extraneous. And extraneous items would be items that don't impact spending, items that impact spending beyond the 10-year budget window, et cetera. The rules get a little bit detailed, but just so you understand that it can really be used to pass significant bills. Budget reconciliation was the tool that was used to pass the Affordable Care Act back in 2013. It was the tool that was used to pass the Tax Cuts and Jobs Act back in 2017. And it was the tool that was used to pass that American Rescue Plan Act in March that I mentioned. So again, all three of those bills were very partisan. They only got the bare minimum votes from the party that had the majority at the time. And that is the process that could potentially occur if the House and the Senate move forward with the president's plans and the plans to craft some legislation that fits with those plans. So what's happened over the last couple of days? Well, we're going to hear this word called cloture, and this is what was filed last night by Senator Schumer, which was basically he took a shell bill that existed in the House already. The House had passed a bill not too long ago, July 1st, on infrastructure. And the Senate isn't interested in passing that bill, but it takes that bill, it just uses it as a shell, right? The whole thing is sort of a little bit of a political game. And it takes that bill, and then Senator Schumer filed for cloture, which basically means, okay, I'm going to kick off a vote on whether we can proceed with debate. And so tomorrow is the plan, and this could change. As early as 11 o'clock, the Senate will vote to end debate, which would prevent a filibuster, and move forward on a final vote for the legislation. So the final vote on the legislation won't be happening tomorrow. The first process is to sort of kick off the debate. And this would be for the infrastructure, the physical infrastructure bill. Right? So this is not for the human infrastructure bill. This is step one. This is the bill that seems to have a little more bipartisan support. But again, there's no actual language yet here. It's just going to open up debate. And the idea is, okay, we'll talk about this. We'll get the language pulled in. Maybe Thursday and Friday, we could actually have something that we actually vote on. So it's sort of a very interesting process. Don't know where it will go. As proposed, I've included in your slides that I think you'll get as a handout or maybe get emailed to you, and we're not going to talk about everything, but I wanted to give you some additional resources that you could use after this discussion. The original proposal that was included in the president's proposed budget, this physical infrastructure bill, is where they would put aside money to fix highways and build bridges and upgrade ports, et cetera, to implement high-speed broadband for rural Americans and just kind of invest in a lot of things. It has other provisions in there too, but that's sort of the idea that this would be for the physical infrastructure. And originally it was to be paid for with an increase in the corporate tax rate from 21% to 28%, and then an assortment of what we call sort of global taxes. Well, this is all something that has gotten weeded out as there's been this bipartisan debate. So that's part of what we don't know yet, is how this would be paid for under whatever language might be unveiled later this week. So stay tuned on that. Part two is actually the more impactful plan, in my opinion. The physical infrastructure would be very helpful and useful for all of us, so that's great. But in terms of the pay-fors of that plan seem to be less wide sweeping than the pay-fors that have been included in the $3.5 trillion reconciliation package that's been proposed. If this package went through, this would seem to completely overhaul current estate and business planning for all of us, for agricultural producers, for rural landowners. It would have very significant impacts because it would really change the rules of the game for what happens when you die. And so that is what I want to spend time on. We may see a little more discussion about this after the original infrastructure hurdle is passed, to see what happens with that. Again, no one knows how any of this is going to end, but I want to just spend the rest of our time looking at what the president has called the American Families Plan, and what would now be rolled into this budget reconciliation plan that the Democrats realize they will not get the Republican votes. It's not clear if they'll be able to get all of the Democrat votes, but they know they wouldn't possibly be able to get more than the 50 votes necessary to pass through reconciliation. So this one isn't headed for any sort of bipartisan vote. This one is one that would be passed through budget reconciliation. And again, all of this would likely have to happen by the end of September, most likely, or it could be pushed to the end of the year. But there seems to be a push sooner rather than later to get things rolling. So the proposed benefits, before we talk about the cost, I think it is important to at least kind of understand what's being proposed so you know what it is that's being paid for. But the proposed benefits are $1.8 trillion in things like making that child tax credit increase permanent. It would include 4 years of free education, which is 2 years of free preschool, 2 years of free community college. It would have child care credits that are extremely higher than they have been in the past, a number of different benefits for families with children. And then most recently reported, which was a compromise to Senator Sanders, is an expansion of Medicare to include dental, hearing, and vision coverage. So again, this part of the plan, the American Families Plan, the budget reconciliation plan, is focused on provisions as stated by the administration to sort of lift some families out of poverty and to increase education for others. For the tax credits, those would include that increased child tax credit, the dependent care credit, the earned income credit, and then permanence to expansion of the Affordable Care Act, which is the marketplace insurance that some folks have. So very expensive, right? So how does the administration or how does Congress plan to pay for that? Well, this is where we're talking about tax increases. And this is why we're talking about this now, because there is significant push to get some of this passed. Again, don't know where things will end up, but here are the proposed pay-fors. So I'm just going to quick sketch out what the different tax increases or tax changes would be. And then what I'd like to close with are some real world examples of how the current law works versus how things would work under the proposals. So again, your slides will have more detailed information. I want to keep this at a fairly high level so that everyone stays on board and eyes don't glaze over. But the first proposal is just to increase the highest tax rate on ordinary income back to where it was before the Tax Cuts and Jobs Act. So currently our highest ordinary income tax rate is 37%. And so this plan would increase it to 39.6%. Not a huge change. It would also lower the income threshold, however, at which that top rate is triggered. So under current law that we have this year, we have a 37% tax rate. And if you're married, that doesn't kick in until you have $628,000 of income. Under the proposed plan, you would have a 39.6% tax rate. if you had over $509,000 of ordinary income. And hold on to that thought, because it may be like, well, I never have that much income. If I sell something, it's capital gain income. Well, hold on, because that's where we're coming to proposals that would actually trigger this rate if you had capital gain over $1 million. So that's this proposal. The second part of the plan, and this is how the president proposed it, would be to eliminate that preferential capital gain tax rate that we have currently. So currently our highest capital gain tax rate is 20%. And that only kicks in if you have income above $500,000 of capital gain. And there's a possibility of adding a 3.8% net investment income tax on that. And of course, any state tax that you have. But on the federal side, we have capital gain rates that will not exceed 20% under current law. Well, this plan would say, well, if you have capital gain over $1 million, and the proposals are aimed at wealthy individuals is what the proposal says. And where we get our information for this proposal is from what's called the Green Book, which are the budget details that the president has laid out with help from the Treasury Department. And so the way that they explain this is these reforms will reduce the economic disparities among Americans and raise revenue. So these proposals are intended to raise revenue, but more than that, the goal of the proposals are really to equalize wealth. It is how it's been explained. So keep that in mind as we sort of move through the various proposals. But under this plan, if you had any capital gain in excess of $1 million would not be taxed at a 20% rate anymore. It would be taxed at the ordinary income tax rates. So if we look back at what the proposals are for 2022, that would mean if you had capital gain over 500,000, any of that gain would be taxed at a 39.6% rate. Now, where that comes into play, of course, is if you sell an asset that is worth a lot of money. So a couple $1 million of farmland, you would have probably some significant capital gain on that. We're going to look at some examples of how that would work, but any gain over $1 million would not be subject to the 20% rate. It would be subject to the 39.6% rate. And the interesting thing about this proposal is this is the one proposal within the plan that has been set to go retroactive. So you can't escape it apparently now, depending on how it all plays out with the actual legislative language. But the proposal was this would begin for any sales that occurred beginning April 28 of this year. That was the date that the proposal was announced. So the idea is not to have a massive sell-off before end of year or something like that to avoid that higher rate. Also, in addition to this, we'd have this 39.6% highest rate on the capital gain, but the plan also proposes to expand that 3.8%, what we call net investment income tax. So right now, under the current law, we don't pay net investment income tax for anything that's not an investment income asset. So if I'm an active farmer and I sell my farmland, that is an active business asset, I don't pay the 3.8% tax on that. If I cash rent and I sell that asset, I currently do already have to pay that 3.8% tax. And that's just currently on income above $250,000 if I'm married. What the proposal would do is to expand this net investment income tax in conjunction with self-employment tax to essentially apply it to all income over $400,000. Now, already, if you're an employee, if you're self-employed, you're paying this 3.8. It's the Medicare tax plus the Social Security tax. So where this would kind of fill in gaps that aren't currently being taxed is it would apply this tax to, for example, our self-rental income that currently we avoid that tax on. It would apply the tax apparently to the sale of business assets that are active. It would seem like that's the proposal. It would also change the way that S corporation income is taxed, so that currently only your reasonable compensation, if you're part of an S corporation, is subject to FICA, but under this proposal, your distributions from the S corporation would be subject to this 3.8% tax. So again, these are all proposals, but I just want to kind of give you the full look at what is on the table so that you understand what is being debated in Congress and can take appropriate action if you want to discuss these items with your legislators. Also, this is the big one, in my opinion. The most significant proposed change is something that we've never done before in this country. And that is beginning in 2022, the proposal would treat the transfer of appreciated property as a sale. So let's say I die. Currently, right, what happens, and Scott had talked about this during his presentation, when I die under the current law, the basis in my asset that I owned at my death is stepped up to the current value. And any appreciation that occurred, any increase in value that occurred over my lifetime, that's wiped off the table from a tax standpoint. Right? If I had sold the asset the day before I died, I would have to pay capital gain tax on that appreciation. But under the current law and under the law as it's always been, except for a tiny little window in the 70s that was eventually retroactively changed, we've had a basis step up, a tax-free basis step up, where at death we have a reset. And that's really kind of lovely for a lot of different reasons, in that a lot less administrative hassle in terms of tracking basis and all of that. But the proposal is to tax that appreciation at death. So this is not an estate tax, and it doesn't take the place of an estate tax. It's a new income tax, an income tax that's not triggered until you die. So it's kind of the final kiss you goodbye. Here's your income tax bill. You are going to owe tax on any appreciation of your assets during your lifetime. Also, the tax would apply if you gave your property away as well. So most of you are aware that if I currently give away my property, if I decide to give my farmland to my son or daughter, and I have a basis in that farmland of $1,000, and now that farmland is worth $7,000, right? I've had $6,000 of gain. If I die, the basis steps up to $7,000. If I just give it away while I'm alive, the basis stays at $1,000. And whoever I gave it to will own the property with a basis of $1,000, but they don't have to pay tax on that gain until they sell it. Or if they die under current law, their basis gets stepped up to fair market value as well. But under this proposal, the act of giving the property to someone else would trigger tax liability. So that income tax would be due from me at the time I gave the property to my son or daughter. So we're not only talking about taxation of gain, but also, as I mentioned, this tax would be subject to those increases we just went through, where the top tax rate for ordinary income would be 39.6%. That would be subject, that would be the tax rate that applied if any of my capital gain were over $1 million. And I would have that 3.8% net investment income tax applied to any of the income that I would have from that sale above $400,000. So a pretty significant set of proposals here in terms of how it might impact people. Now, there is some good news in this, and the one give me, I guess, the first give me that we have that is good news is there would be an exemption of $1 million per person that would exclude from recognition gain of $1 million for if you're married, each spouse would get their own. So for a married couple, there'd be a $2 million exclusion from the gain. So for example, back to my example of the $6 million in gain, if I'm married, I would carve $2 million out of that, and I would only have $4 million in gain that would be taxable under this plan. I also wouldn't have to pay any tax on $500,000 of gain in my personal residence. So there is that exemption that's sort of built into the law. But what that does for basis is it does give you at death a tax-free step up of $1 million. And then anything over that, you have to pay the new tax on if you're a single person. So an example from the Green Book says if I transfer $5 million parcel of land with $3 million of appreciation at death, it has a $2 million basis, my heir is going to receive my land with a $5 million basis. So some of the headlines say, oh, eliminate the step up in basis. Well, we're not eliminating the step up, we're eliminating the tax-free step up, right? The basis will still step up to the current fair market value. I just have to pay tax on that $2 million of gain that is not included in the exemption. So 1 million steps up without tax, 2 million steps up with payment of the tax. But at gift, this is kind of a unique thing. What the proposal would do is it would give me the $1 million exclusion from paying tax, but it wouldn't give me a step up in basis. So I would still just have a carryover basis with a gift. So in my example here, if I gift $5 million parcel of land with $3 million of appreciation, if I died, my heir would inherit that land with a $5 million basis. If I just give it away, the person I give it to will get the land with a $4 million basis, and tax is still going to be due on the $2 million of gain. And that $1 million exemption gets me off the hook to pay the tax now. But it would have to be paid later if the person I gave the property to sold it. So a little bit of difference there. Now, a couple of things at this point that I want to explain, and like I said, we'll be going through some examples, but I wanted to kind of give you the lay of the land first to kind of understand where we're headed. So this is not an estate tax, right? The estate tax is separate, and we'll talk about the estate tax after we finish talking about this proposal. An estate tax is, of course, taxed on the value of the estate. The current estate tax would still apply under this proposal. This would be a brand new tax at death. And the new tax at death would be taxed on only capital gain. So don't let me lead you down the path where you think, oh, if I have $5 million piece of property, I would owe this tax on all $5 million. No, it would only be owed on any appreciation. Now, some of you have land that has a very low basis, so you have a lot of capital gain. So one thing about this proposal is it would have a lot of disparate treatment throughout rural America, because some land has been acquired recently from a deceased family member, for example. That land would have a high basis. Some land was recently purchased. That land would have a high basis. But if you have land that has a basis that's very low, and then you pass away, there's a lot of appreciation in there that would be taxed under this proposal. Also, there's an interesting proposal for how would this impact other entities. So what we're talking about right now is just land that you hold individually, land that you hold as a tenant in common, land that you hold in joint tenancy. Corporate holdings would be left out of this in terms of C corporations. Gain on unrealized appreciation would be recognized by a trust, partnership, or non-corporate entity, would be taxed differently. And this is where the proposal gets really weird. And I'm not going to go into the details of it because I don't want to confuse everybody, including myself, because we simply haven't been given enough detail to even understand where they'd be headed with this. But just know that they put this in here to say, oh, wait a minute, you're not going to just be able to dump the land into a trust or dump it into an LLC. You would still be subject to tax on any gain in those entities, but the rules would be different. And it's sort of a really interesting rule that says, oh, we're going to tax every 90 years. That's kind of the average life expectancy, give or take a few years, but that's the idea. Make sure that any property within a trust or a non-corporate entity would be subject to tax on gain at least once during a lifetime. Now, there's been other proposals out there, most notably the STEP Act is actually a legislative proposal that a lot of this is based on, that has some legislative language. And some of those other proposals would have the time frame be a lot less than 90 years. But the president's plan says the first recognition event for these trusts, et cetera, wouldn't be until 2030. And then all of a sudden it would be for the past 90 years of gain. Again, don't know how that'll shake out, but that's what's on the table right now. Doesn't cover C corporations, doesn't cover S corporations. And if you see the word trust and you think, oh, I have a revocable living trust, I wouldn't be taxed for 90 years. No, revocable living trusts would be treated just like an independent, they'd be disregarded for this purpose. So they'd be treated the same way as if you just owned it outside of the revocable living trust. So that won't be a way around this rule. So a couple of other items that are very unclear in terms of how they would be handled is how would gain on equipment, for example, be handled? We're not sure. The proposal doesn't spell that out very well. So the example, of course, is we have a lot of farm equipment. It's usually very highly depreciated or it's been expensed fully. So the basis is often zero, but it's worth, several $1 million, all the equipment that we have. Doesn't explain what would happen to that equipment at death. So, we're just left to fill in the details on our own on some of these and just kind of wait. Now, one of the pieces that's been talked about quite a bit by the administration and by some of the proponents of this plan, because it's apparent that when you talk about taxing gain at death, one of the concerns is the small family business, the family farm. This is not the estate tax, which historically has not caused really anybody to sell the family farm. We haven't had that situation in the past. This is different. This taxation of gain at death or gift would be very challenging for some family-owned businesses. And so the administration has said, oh, we're going to have a deferral for any tax that would be due from a family-owned business. Now, a couple of items to keep in mind with that language. The language isn't that these businesses would be off the hook from the tax. The language is that the tax would not be due until either the business was sold or the business ceased to be family owned and operated. So that is a really important deferral provision, but it's also one that's really hard to define. So what would be the rules that would define a family owned and operated business? Would you qualify for this deferral if, for example, you were cash renting your ground to a family member. Would you qualify for this provision if you were cash renting it to a neighbor? Current tax law that looks at whether or not you're actively running a business wouldn't count those particular situations. So there might be a lot of family business situations, ways that farm businesses are set up that potentially would be left out of this deferral provision. But nonetheless, we've been promised a deferral provision if indeed this tax at death goes through. There's also a separate provision that if you're not allowed a deferral, that there would be a 15-year fixed payment plan for the tax on appreciated assets. So you'd have 15 years apparently to pay the tax if indeed you weren't allowed the deferral under the current plan. So again, this is one of the big questions that we have in terms of how a deferral for a family-owned farm, for example, would work. It would still be a tax liability. So there's concern that it would impact ability to get credit, et cetera, because that liability would be out there, because at any point where the definition of family-owned business ceased to be met, that tax would be due. So again, lots of questions about that. The details of that, if they come out in legislative language, will be very important. It will also just be important how family is defined, whether it's defined narrowly, whether it's defined broadly. The special use valuation that we have right now that someone mentioned earlier this morning is actually pretty narrow. Don't know if it'd be modeled after something like that or not. So again, lots of questions, but I wanted to kind of walk you through what the proposals are. And so that's where now what I'd like to do is just turn to some examples to sort of put some real situations out there for you, just to kind of see how this would all play out. So current law, how does current law work? Well, many of you know that people are holding property until they die for that beautiful death gift of a tax-free step-up in basis. So, that is one of the reasons that some of the proponents of the plan put forth that gain should be taxed at death, is to avoid this lockout where it's really hard to buy farmland. But on the other side of it, we have arguments that, but if you tax the gain at death, we're going to have all this farmland forcibly sold, perhaps, to pay the tax. And that will be putting that farmland in the hands of those who can afford it, which most likely might be wealthy investors, moving it outside of the rural communities, the ownership of that property, et cetera. So lots of policy debate going on. But let's just say we have a typical farm family, Harris and Harriet. Let's say they have 1,000 acres of farmland, but the basis of their farmland is really low. And of course, this isn't the everyman situation, but it's fairly common across the rural landscape that we have low basis because it was purchased early in the farming operation. So in Harris and Harriet's situation, maybe they purchased 500 acres at $550 an acre. They purchased 500 acres at $800 an acre. And so we know right now, if they sold it under the current law at current gain rates, right? If they're farmers, the top capital gain that they would have to pay would be 20% on the amounts over roughly 500 some odd $1,000 of gain. And so if the land is worth $7,200 an acre at the time they sell it, they would have $6,500 of gain per acre. So if you apply all the current rates, right, what they would owe is $1.2 million of tax on that transaction. So they'd get the $7.2 million collection, and of that, $1.2 million of it would be payable in tax. Roughly 17.6% of the sales price would be would be tax liability. That's current law as it stands. Now, if they weren't farming it, if they were cash renting it, current law would also impose that 3.8% net investment income tax. So 20.9% of the sales price. Now, assume for simplicity that we have Harris and Harriet die together in a car accident. So we don't have to worry about who died first. We do all that. In that case, under current law, as we know, this basis that we see from the previous example, right? We had a low basis. We had $6.5 million of gain. All that gain would be wiped away, and the basis of this property at their death would be reset, fresh start, to the fair market value. Nobody would owe any tax, and it would pass to Jordan, for example, if she was their heir, without any income tax. And under current law, there would be no estate tax due because they're well under the current exemption amount of $11.7 million per person. So again, pretty good result tax-wise under current law if Harris and Harriet die. Now, if Harris and Harriet instead gift their property to Jordan while they're alive, there's no gift tax liability because it's under that exemption of $11.7 million per person. The only difference, though, is under current law, of course, if you gift the property, then Jordan will take the property. No tax will be due now, but she'll take that property at the low basis that Harris and Harriet have. So she gets what we call the carryover basis. So she'll get the $500 of 500 acres at $550 an acre, and she'll get the other 500 acres at $800 an acre. So if she wanted to sell it, she would have to pay that capital gain tax, the same capital gain tax that Harris and Harriet would have to pay if they sold it. But otherwise, there would be no tax liability if they just gave it to her and she kept it and she went on about her farming business. No tax would be triggered. Now let's look at the proposals on the table with the American Families Plan and how this would impact our family. So in the first example, let's say Harris and Harriet continued to sell the land, continued to farm the land. And let's say they decide to just sell the land. Okay, so under the proposals on the table, just selling the land, the difference in tax liability would be pretty significant. Instead of owing $1.2 million at their sale, they would owe $2.59 million in tax at the sale. So just the change in the way that gain is taxed at sale would trigger significant increase in tax liability just upon a regular sale. But where we would have the most impact is if Harris and Harriet died. Now, just to keep things simple, we're going to just take Harriet out of the picture and we're going to pretend that Harris owned it. It just keeps life easier. So let's say that Harris is the only owner of this property, and let's say that he dies. And so if he gives the property to Jordan at his death, under this proposal, he would have a $1 million exemption. So he would only have $5.5 million of taxable gain, but that would still lead to an approximately $2.1 million tax bill, or 30% of the fair market value of that property, given the significant capital gain that Harris had over his lifetime. So Harris would die, there would be a tax bill triggered of $2.1 million. If Jordan was not farming, that tax would be due and owing, although she might have 15 years to pay it off. But you'd have to kind of run the numbers about the cash flow of that significant tax. If she were farming, that tax might be deferred, but it wouldn't go away. That liability would be triggered. It would be there. We don't know how long. We don't know if at some point it would go away. But the proposal doesn't say that. It just says that tax would be deferred until such time as as a family member was no longer actively farming or actively operating the business, or until such time as the business was sold. So again, lots of question about how that deferral would work, but it would mean essentially that the tax liability would not be then determined at the time of sale. It's already been determined. That liability has been established. That liability has been established under these higher tax rates that would just be sitting there as tax due that wouldn't become enforceable essentially until such time as the family business ended. Under the proposal, if I just gave it to Jordan instead of dying, then that tax would also be triggered. And the tax liability would be the same. It would be a $1 million exemption. And then I would be subject to $2.19 million of tax would be due. But notice Jordan would then get the farm via this gift with only a $6.2 million basis. She wouldn't get the $7.2 million basis because it's a gift. So she would get a carryover basis for that exemption amount. And the rest of it she has to earn through payment of the tax. So again, significant tax liability would be generated from a gift of the property as well. Now, the last change I want to talk about and give you an example about in the proposal is to significantly limit the 1031 like-kind exchange as well. And so what the proposal would do is say, you can only defer $500,000 in gain a year for a married couple using a 1031 like-kind exchange. So even though the Tax Cuts and Jobs Act eliminated the tax-free exchange for personal property, it left in our tax-free exchange, of course, for real property. And we love that because if we, for example, have property over here and we want to move somewhere else, or a piece of ground comes up for sale that's close to our other farmland, but we had a remote piece over here that we purchased a very long time ago with a low basis, we can trade that remote piece of property to consolidate to get closer to the rest of our land. And for example, and under current law, it's just a tool that shifts the basis from that property to this property. There's no tax liability due. Under the American Families Plan, there would be a tax liability due under this proposal, and it would be such that some like-kind exchanges would not be useful at all. In fact, most of them, a lot of them wouldn't, if we had anything over $500,000 in gain that we were attempting to defer. So here's an example. Let's say Martin farms in Western Illinois. He wants to move to Eastern Illinois to be closer to his family. His 500-acre farm, which was a lifetime gift from his grandfather, has a really low basis. So his grandfather gave him the land, so the basis is $600 an acre. That was kind of a common strategy for people who want to keep farmland in the family. Sometimes they gift it during lifetime thinking, well, it has a low basis that way, and then they won't want to sell it. They'll hold on to it. It will keep the farm in the family. So that's kind of been a choice that some folks have made. So let's say grandfather gives the land, low basis, $600 an acre, and now it's worth that $7,500 an acre that we talked about with Harris and Harriet. And Martin wants to get a farm in Eastern Iowa of equal value, right, to get closer to his family, as we said. So under the current law, he can just swap and no tax liabilities due. He just takes that Eastern Illinois farm and he takes it at $600 an acre, and life is good. He doesn't pay any tax unless he decides to sell the land. Under the American Families Plan, the example that we give would have total gain of $3.45 million. He would only have a $500,000 exemption. So he would have to realize or pay tax on, recognize $2.9 million of gain, which essentially, if we're cranking out the numbers, would be over $1 million in tax liability for that $3.7 million exchange. In other words, the exchange would lead to a tax liability that would be equal to 28.4% of the sales price. So it would eliminate that tool from the toolbox in some situations that allows us to consolidate farmland, to relocate farmland. Again, with a like-kind exchange, the policy behind it has always just been, I'm not changing my economic position. And because I'm not changing my economic position, I shouldn't have to have tax liability triggered because of that. So what about the estate tax? We just walked through the examples, and in the couple minutes I have left before we open it up for questions, I just want to remind us what the current law is with respect to estate tax. Because remember, everything I've just talked about in terms of the tax proposal has to do with a new income tax, a totally new tax system that would completely leave in place our current estate and gift tax. So the president's plan did not reference the estate or gift tax. There is one proposal on the table from Senator Sanders that has some legislative language called the 99.5% Act, and that would significantly reduce the exemption amount. But right now, under current law, we are set to have a reduction of our exemption amount to roughly $6 million once we index it for inflation come 2026. So my thought is that they're really not pushing too much to do anything with the estate tax. They want to move forward with this income tax with the idea that it's already set to drop back to pre-Tax Cuts and Jobs Act levels on its own after 2025. But here's sort of a history of our estate tax exemption amounts. You can see there on this chart where they're at. And so, as I mentioned before, under current law 2021, we each have an $11.7 million exemption. It's very high. We each have it. If you're married, each person in the family has it. So you can die with significant assets as a married couple and not owe any estate tax. In fact, the estimate is that 0.16% of any farm operators would owe any estate tax under today's system. So the estate tax under current law definitely isn't causing family farmers to sell the farm, et cetera. The tax, of course, if you're subject to it, is quite high. It's a 40% tax. Again, we have to watch where this goes. But the income taxes that are proposed under the American Families Plan, they would simply be deductible from the value of the estate. So again, the two tax systems would coexist. So people that have estates that are higher would be subject to both. And Jesse's popping up because she's going to open it up for questions, which is awesome, because I'm just wrapping up to say, what do we do with this information? It's a lot of technical information. It's a lot of unknowns. I want to share it with you. I want to share it with people just because, it's too early to go run to Scott and say, hey, I need to set up this trust, or I need to do this, because we don't know what's going to happen. But it's definitely something that we need to watch closely. So everyone needs to know what's being discussed in Washington, just so that you are on the ball, that you're watching and you're ready to take appropriate action if indeed some of this legislation gets through. So we'll be keeping our eye on it. I know your team out there that's working with you on this webinar will be as well. And we'll just see what happens. And so Jesse, are there any questions out there?
Yes, there are. Thank you so much, Christine. We will be taking questions for about the next 10 minutes or so until we run out of time here. But I have a few questions that have come up. The first one is from an audience member. So we know that investments fluctuate. We know that our retirement accounts go way up and then they go way down. Our stocks fluctuate in the same exact way. So the same way that land prices are extremely high right now, and we think that there may be a reduction later depending on what happens with the economy. Is there going to be, or would we think there might be some sort of a credit back if we pay this tax on really expensive land, and then we see some sort of a drop in the economy, and then we see land prices deflate. So
yeah, what a great question, because just fairness, when I look at some of these proposals, cries out that very same question. But there is nothing in this proposal that would give us such a credit back. In fact, the whole idea is it's kind of the luck of the draw when you die. And that's part of the challenge of something like this. Part of the challenge for why a system like this has never really gone into effect before. A couple of big hurdles, right? One is basis records. How do we go back and piece together all of the basis records that need to be there? The beauty of death has been, okay, we're in the middle of this death, and most of us are mourning the loss of a loved one. The only good news is, okay, we just get to reset everything, right, to fair market value. And we don't have to, we have to usually get an appraisal or something, but it's a little less stressful in terms of what the fair market value is for most of us, because there's not a tax triggered right now. The importance of that fair market value is for the basis records for the heirs, so that moving forward, if they sell it, they know what their basis is. But yeah, if this tax went into effect, then we would have to not only dig up all of our basis records, but we would have to have a really significant appraisal that would take place as of the date of our death, or maybe 9 months after. I don't know how they would do that exactly. But then, yeah, let's say that 2 years from now, then the price just dives down because everybody's having to sell their land because they're having to sell it to pay taxes. What happens then? Well, the proposals don't have anything in there that would compensate you for that. So lots of challenges. Again, that's why these are proposals. And when they actually start debating the details like you're talking, I think that's where some of these might put some red flags up to some legislators. Also, just the whole idea of the fairness thing. You know, we have identical parcels of land across the road from each other, right? And one of them, the person just inherited it, so basis is fair market value. The other one that was received as a gift from somebody and has a really low basis. Well, if both of those people died tomorrow, you know, one family would get the land tax free, and the other family would owe a whole bunch of tax on it for identical parcels, identical economic situation. And again, to me, that becomes a fairness thing as well.
Sure, I understand that completely. What kind of advice are you thinking we would give people who, if this does pass, they can't find the basis because their parents inherited it? I don't even know. There's so many reasons why you wouldn't be able to find the basis, but some of this old land, family land, is going to be difficult to find that basis. So what kind of advice would you give people who may be struggling to find those pieces?
Yeah, that's a really great question. And when we raise that question with folks in Washington, they all say, well, things are different, than they used to be. There was a time in 1970s where they passed a carryover basis. They said, oh, we're going to eliminate the tax-free step up. We're going to have a carryover basis at death. It was in effect for a couple of years, and then it was retroactively undone. And the reason it was undone was that very reason that, basis records are so hard to find. This is really, really challenging. Well, what they say is, well, those times are past. That was then, this is now. Now we have great technology. You can just look things up on the internet, etc. And what we forget is a lot of their thought is thinking about stocks and portfolios of assets that it is easy perhaps to go back and find the historical basis. But yeah, land records, improvements that we've made to the land, et cetera, that would be a challenge. And we just have to wait to see if there's some sort of safe harbor that would be applied. I mean, under current law in the tax world, if you can't find basis records and you've got nothing to put forward to show how you establish the basis is zero. So that would be pretty challenging. So we just have to sort of wait and see what any legislation would say. But that's an excellent question.
All right. Well, the next question is, would there still be a benefit in the new tax proposal to allow an heir to buy the family farm at death with the IRS special use valuation?
So one thing that we've said about the special use valuation in the modern era is it hasn't been very helpful, right? If you followed the valuation that you get, that's a decrease. It's like 1 point some odd million dollars. Essentially what it does is it allows you to value the land that much less than what the actual fair market value would be. And with our exemption amount at $11.7 million for the current estate tax, it would help somebody that just is over it. But if you're significantly over it, it does very little for you. If you're under it, it does very little for you. So it just helps a little narrow window of people currently. One thing that would be useful is if the special use valuation could be increased to more line up with current day values. But the special use valuation would have absolutely nothing to do with this new income tax proposal. The proposals that are on the table don't mention anything at all about special use valuation or the application of that. They account for what they're trying to do is use that $1 million exemption to say, okay, we'll knock $1 million off. And then after that, you're on your own. So, again, maybe something like that would be introduced, but it's not in the current proposals. Good questions.
So I think my last question at the moment is, you put up there with the current estate exemption limits that we have, 0.16% of our farm families are affected by the estate tax, or have to pay estate tax, I should say. So has there been any research done at this time to say this is how many will potentially be affected if we drop to this really low exemption number?
So that's a great question, but I want to make sure we keep things separate. So when we're talking about a $1 million exemption, we're talking about a $1 million exemption from income taxation at death for appreciated property. So remember, these are two mutually existing systems that the estate tax would stay where it is. If we drop back in 2026 to the $5 million, roughly $6 million once we index for inflation, we'd probably be back to where we were roughly, because the index is indexed for inflation as well, before the Tax Cuts and Jobs Act, which still had a very low number of farms that were impacted by having to pay estate tax. I think in 2016, I believe there were 600 farms around the country that actually had to pay estate tax in that year. And that was before the doubling. So, if they dropped the exemption down to $3.5 million, as Senator Sanders has proposed, that would definitely be a lot more significant hit, but we'd have to see. The $1 million exemption in this new income tax, there have been some studies that have been done. Your friends with Farm Doc in Illinois have done a study a little bit analyzing some Illinois farms. The Key State group has done a study. The Texas A&M group has done a study. I'm working with a colleague at Iowa State. We're just about to release some numbers too, in terms of how many farms would be impacted by these proposals. So we're closely tracking it. It's a little challenging just because we don't have the details of the what the law would look like. But as proposed, the best we can do, we're looking at what percentage of people would be impacted. But great questions. And I appreciate you raising these issues.
Well, thank you so much. Unfortunately, that's all the time that we have for today. Christine, thank you again for your very insightful information today. We always appreciate that. Just want a reminder, if you are a CCA, don't forget to claim your one CEU in professional development for this session. You can either scan the QR code or email our team with your CCA number to submit for credit. I would like to thank again both Scott and Christine for their presentations this morning, and thank you all for attending the first day of the AMP Summer Seminar. Don't forget to tune in next week to the summer seminar on Tuesday, July 27th, beginning at 9 a.m. You can find more information about these sessions and more at ilsoyadvisor.com. Thank you again and have a great day.